Welcome, ladies and gentlemen, to a journey that could transform your financial future. Today we're diving headfirst into the world of stocks, bonds, and trading, where fortunes are made and lost every day. Are you ready to master the stock market and unlock the secrets of successful trading? If so, you're in for a treat, because in this video, we'll unveil the tips and tricks that can help you navigate the treacherous waters of the stock market with confidence. So sit tight and fasten your seatbelts, because by the end of this video, you'll have the knowledge you need to start trading like a pro. Welcome to our channel. Today, we're diving deep into the exciting world of stock market trading. Whether you're a beginner looking to get started or an experienced trader aiming to refine your skills, this video is packed with valuable tips and tricks to help you succeed in the stock market. 1. The basics. Before we jump into the tips and tricks, let's start with the fundamentals. If you're new to trading, this is essential. If you're experienced, it's always good to refresh your knowledge. Stocks, or shares. Stocks represent ownership in a company. When you buy a stock, you become a shareholder in that company. Companies issue stocks to raise capital for various purposes, and shareholders may receive dividends, profits, and have voting rights in some cases. The value of a stock can fluctuate based on the company's performance and market conditions. Stock exchanges. Stock exchanges are platforms where stocks are bought and sold. They provide a marketplace for investors to trade shares. Examples of well-known stock exchanges include the New York Stock Exchange, NYSE, and the Nasdaq in the United States. Stock exchanges facilitate transparency and liquidity in the market, allowing buyers and sellers to find each other. Market orders. A market order is a type of order placed by an investor to buy or sell a stock at the current market price. When you place a market order, you're essentially instructing your broker to execute the trade immediately at the best available price. 3. Market orders are typically executed quickly, but the exact price at which the order is executed may vary slightly from the current market quote due to price fluctuations. 2. Setting your trading goals. Now that we've covered the basics, let's move on to setting clear trading goals. This step is often overlooked but crucial for long-term success. Realistic goals. Realistic goals in trading help you define what you want to achieve and set clear expectations. They prevent you from making overly optimistic or unrealistic targets that can lead to impulsive decisions and losses. Setting achievable goals allows you to measure your progress and adjust your trading strategy as needed. Risk tolerance. Understanding your risk tolerance is essential to determine how much risk you can comfortably take in your trading activities. It helps you avoid taking excessive risks that could lead to financial stress or emotional turmoil. Your risk tolerance should align with your financial situation, investment objectives, and emotional resilience. Time horizons. Your time horizon is the period over which you plan to achieve your trading goals. Short-term traders may have a different time horizon than long-term investors. Matching your time horizon with your goals and risk tolerance helps you choose appropriate trading strategies and asset classes. 3. Risk management. One of the most critical aspects of successful trading is managing risk. Let's talk about some strategies to protect your capital. Stop-loss orders. A stop-loss order is a preset price at which you decide to sell a security to limit potential losses. It acts as a safety net, automatically triggering a sale if the market moves against your position. Stop-loss orders help control risk by defining the maximum amount you're willing to lose on a trade. Diversification. Diversification involves spreading your investments across different assets or asset classes to reduce overall risk. It helps prevent the impact of a poor-performing asset from significantly affecting your entire portfolio. Diversifying can enhance the potential for stable returns while managing risk. Position sizing. Position sizing is the process of determining how much capital to allocate to a specific trade. It's based on your risk tolerance and the size of your trading account. Proper position sizing ensures that no single trade has the potential to wipe out a significant portion of your capital. 4. Technical analysis. Many traders rely on technical analysis to make informed decisions. Let's delve into some essential tools and techniques. Candlestick patterns. Candlestick patterns are visual representations of price movements on a chart. They provide insights into market sentiment and potential trend reversals. Examples include doji, indecision, hammer, bullish reversal, and engulfing, bearish reversal, patterns. Moving averages. Moving averages are used to smooth out price data over a specified period. Simple moving averages, SMA, and exponential moving averages, EMA, are common types. They help identify trends and potential support/resistance levels. RSI, Relative Strength Index. RSI is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is used to identify overbought, above 70, and oversold, below 30, conditions. Traders use RSI to spot potential trend reversals or confirm existing trends. Chart patterns. Chart patterns are recurring formations on price charts that can signal potential price movements. Examples include head and shoulders, reversal, ascending triangle, bullish, and descending triangle, bearish. Chart patterns are used to make predictions about future price movements. 5. Fundamental analysis. Apart from technical analysis, understanding the fundamentals of a company is vital. Let's discuss how to analyze stocks from a fundamental perspective. PE ratio, price to earnings ratio. The PE ratio measures a company's current stock price relative to its earnings per share, EPS. It helps investors assess a stock's valuation. A higher PE may indicate that a stock is overvalued, while a lower PE may suggest it's undervalued. Earnings reports. Earnings reports, typically released quarterly, provide detailed financial information about a company's performance. These reports include revenue, expenses, profits, and other key financial metrics. Traders and investors analyze earnings reports to gauge a company's health and growth prospects. Dividend history. Dividend history tracks a company's past dividend payments to shareholders. It indicates a company's commitment to returning profits to investors. Consistent dividend payments and a history of dividend growth can be attractive to income-oriented investors. Thank you for joining us on this journey to master the stock market in part 1 of our series. We've covered a lot of valuable insights today, from understanding market fundamentals to making informed investment decisions. But our learning journey is far from over. In part 2, we'll delve deeper into essential topics like emotional control, building a solid trading plan, selecting the right broker, and uncovering more tips and strategies for success in the world of trading. So, stay tuned for the next installment, where we'll equip you with the tools you need to navigate the stock market with confidence. Remember to subscribe, like, and hit that notification bell so you won't miss out when we release part 2. Thank you again for watching part 1, and we look forward to seeing you in part 2 as we continue to master the stock market together.